Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Mike Wilson of Morgan Stanley writing, this week's reciprocal tariff announcement is likely a stepping stone for further negotiations as opposed to a clearing event. Mike joins us now for more. Mike, good morning.
Good morning, John.
Why is that distinction important?
Well, I think that everybody's looking for like a final piece here. This is gonna take time, and not unlike a lot of the other policies that have come out this year. Like this is what we kind of signed up for, right? I don't think what the president has done has really been surprising. All of the policy changes so far have been growth negative, and that we've likened this to a new CEO coming in, right? They want to restructure the company. They're restructuring the company. They're going to kitchen sink it. And then they're going to try to make their plan work for next year. So this is going to take some time. And this level that we're at now is critical from a market standpoint, not so much from the administration standpoint. I think that's also something to acknowledge.
It's also very on brand for Trump to take a maximalist approach in the very beginning. But how messy could it be if he comes in with this maximalist, aggressive approach, and then we have retaliation from trading partners?
Well, look, it's the NAFTA. It's sort of like it's the best alternative to a negotiated agreement, and the BATNA, and that is classic negotiating tactic. You come in and way over here to the right with the hope of kind of settling in the middle. So I don't think that's unusual either. The response from trade partners is that means they're engaging. Okay, so that's how you get people to engage in your discussion. You come out with a big splash. They have to come to the table and negotiations begin. We're not even at the table yet. Okay, so that's why this is going to be very uncertain for a period of time.
I think some countries think that they are at the table because they sent a few representatives here the past few weeks. But I agree with you; it really hasn't started. So what do you do if you're an investor? Well,
you've done what we've sort of done. You avoid the areas that are going to be most affected. Consumer discretionary goods, and that area has been hit the hardest. So maybe that's getting a little bit extreme. I would say, defensively positioned, high quality. That's been our core portfolio. Now we've made some trading calls lately that would have gone against that. Some of those worked, some of those didn't work. But I think at this point you want to be up the quality curve. You want to be in businesses that can kind of mitigate some of these concerns. You have pricing power. You have the ability to kind of move production around. You can take inventory on to kind of buffer this for 60 or 90 days, which we've seen all of those mitigation strategies. Something we wrote about in our note today. So those are the kind of companies we want to own in this period of time. I do believe there will be a clearing event at some point this year, but we're not there yet.
Some of the changes you have made that are working, let's talk about them. International, DAX this morning, down 2%. Nikkei overnight, down 4%. International starting to turn. Subtle change from where we were over the last month or so. What's changing?
Well, that's right. And so last week's note, we kind of made the call that U.S. probably does better than these other regions because at the end of the day, those regions you mentioned are most sensitive to global trade, particularly Japan. So the fact that that was down 4%, I think, is another sign that, hey, actually the market now is laser focused on this tariff or trade issue as opposed to some of the other issues that it's been kind of worrying about here. So that relative value, if you will, still looks good to us. It may happen in a down tape. Okay, which is also something to consider because the U.S. is still the highest quality market in the world, and in a uncertain world, high quality will outperform.
But you think those European longs that have built up over the past few months, they might be in trouble here?
I think that's right. I think there's a little extension, and our European strategy team is in the same page. There are some good things going on in Europe that haven't been happening for decades potentially, but boy, that's going to take even longer than this sort of tariff negotiation. You're talking about countries spending more money on fiscal deregulation. This is a multi-year transition in the stock market. In some cases up 15-20%.
So besides Rheinmetall or any other industrial military company in Europe, do you like anything there?
Well, I think the financials have been still a place to think about that have a potential structural change, a benefit in that regard. I think things that have levered to the consumer, but once again, these kind of got extended, and from my standpoint, I think there's better value now in the U.S. in some of these areas.
I'm sure you saw the new numbers coming out of Goldman Sachs and the team. New forecast from Jan Hatzius, if we can just throw them up on the screen. 1% on GDP. 3.5% on PCE. That's a stagflationary mix. What are you telling clients that are asking you about how we would trade stagflation in America?
We're not quite in the stagflation camp. We're more in the camp that, expectations are probably not where reality is, which is that growth is worse than people thought, and inflation's a bit stickier, and that's how we came into this year. So we didn't mess around with our year-end targets, but we have been messing around with our short-term targets. So we're in that 5,500 to, I would say, 58, 59 now. We've kind of chopped off the upper end of that for the first half of this year. I'm not willing to throw in the towel yet completely on the full year because, as we've been saying, the good stuff of, the policy changes that we expect could start to feed into the equity markets by year end. Could we push that timing out, 3-6 months? Sure. But, right now we're still in that 5,500 to 6,100 range with probably a truncated upper band. And now if you get universal tariffs, which is something that we talked about in this morning's note, then that lower half, that lower end of the band maybe comes down. So we're, if we break down this week and universal tariffs are the reason, we could see something even lower than 5,500 in the short term.
Can we talk about the rebalancing you're expecting, though? The ultimate vision of this administration and why you still believe the more complete policy mix is still bullish?
Yeah, I think it's constructive. I'm not sure it's wildly bullish because, valuations were probably the biggest constraint coming in. I think it's bullish for a lot of parts of the market that have underperformed for the last 3 or 4 years. I mean, our vision, or I think the administration's vision, quite frankly, is very simple. They want to effect a slowdown in government. They want to kind of liberate the private economy through things like deregulation, keeping tax rates lower. Maybe tariffs are part of that storyline, fine. And that transition from kind of public government allocation of resources to private enterprise allocation of resources actually at least start broadening out. Something that's been, absent really for the last 2 or 3 years, something, we've talked about here many times, is this crowding out feature. Of the government crowding out small businesses, crowding out the average consumer, and look, I think they've been crystal clear in sort of their messaging. It's not going to be fun for a period of time. Okay, we have to sort of detox, as the Secretary Treasury mentioned. That there's going to be an adjustment period, as the president has said. So it's been crystal clear what they've been doing.
The whole eat your vegetables, then get a dessert. When it comes to the dessert, we're only talking about current policy extension. How exciting is that for the market if you're just talking about an extension of TCJA when it comes to tax cuts and not actual additional tax cuts?
Well, okay, so what you're talking about is fiscal stimulus, and that's what we have to detox from. So we don't need more fiscal stimulus. We need less fiscal stimulus. We need the private enterprise of America doing organic growth.
But if taxes are going up on sales goods, don't you need more tax cuts for individual?
Well, that's the idea, is that we're going to keep taxes lower, maybe lower them further if tariffs, A, bring in revenue, and B, there's a negotiating ploy. So we'll see. I mean, this is going to be very messy, and this is not going to be easy transition. But John asked, what is the bullish story, over the next 12 months? I think it's that, and it's going to be a lot of uncertainty. But I still think that is the plan. I still think what I see so far is a direction in that manner. And look, stock operators and financial market operators are just going to have to deal with this adjustment, and that's the consternation right now.
We're attempting to deal with it right now. Mike, it's good to see you. So here's the latest this morning. President Donald Trump planning to start his reciprocal tariff push on all countries, tempering hopes that the initial scope could be limited on Wednesday. Henrietta, Treyz of Veda Partners joins us right now for more. Henrietta, let's start with the $1 trillion question. What happens on April 2nd?
April 2nd at midnight, lots of tariffs start going on. So it's going to be a really long day. We'll obviously get the reports from USTR, Commerce, and Treasury on the 1st. I think there's going to be a lot of advance warning provided by those documents. We have trade agreements with 20 different countries. And I think when the president says we're going to tariff everybody that we're talking about, he means those 20 countries. So I'm expecting to pull out of the phase 1 China deal or call them out in violation of the deal, which means that all the Section 301 tariffs covering over $350 billion worth of goods from China will go up. I think we're going to see new tariff investigations start on India, for example, pharmaceuticals. I think there's going to be new tariffs under Section 232 and IEEPA across the auto sector. I'm very wary about auto parts. I think that'll be sort of a secondary event that happens in a couple months' time should any of the nations like the EU not come to the negotiating table sufficiently. It takes a long time to get through. There's a lot coming.
Henrietta, what do we see that can happen almost immediately when it comes to IEEPA or 338? Is that going to specific countries or is that going to industries?
IEEPA is specific countries and industries, although Section 232, the national security justification, is really where a lot of the sector-specific items go. Lumber, copper, dairy, things along those lines would be a Section 232 tariff. My biggest concern with any rationale that's not IEEPA or even 338 is that there's no time horizon to take them off. The Section 232 tariffs on steel and aluminum have been in effect for almost 8 years. The Section 301 tariffs against China have been in effect for almost 8 years. So once those tariffs come on with a rationale, like the auto investigation that they completed during Trump's first term, those tariffs don't come off. So those are the most pernicious. The IEEPA pieces on Canada and Mexico, for example, theoretically can come off in 3 to 6 months. The others have very serious staying power.
Henrietta, when it comes to how the president is approaching Wednesday, he said we're going to start with all countries. Is that where he's going to end?
That's a fair question. I think we start with about the 20 countries that we have trade agreements with. That's what the agencies have been tasked with doing. But I see the potential for expansion before we see any pullback. So, for example, there's no investigation into India. I mentioned that at the outset. I think we have a lot of issues with India, from trade in pharmaceuticals, generic drugs, the trade in services deficit. Those are all sort of institutional issues that we know USTR Greer had during Trump's first term, and I would expect to see a really long drag to any approach to India. So I think a lot more are going to come on in the next 4 years of Trump's term than necessarily come off. Although Canada and Mexico should be excluded, especially USMCA compliant pieces, that trade deal needs to be re-agreed to by next summer.
When it comes to what the Senate is also going to do tomorrow, there's supposed to be a vote on a Democratic resolution blocking Trump's use of IEEPA when it comes to Canada. How difficult is that going to be for some Republicans, whether or not they're going to say yay or nay?
Well, just think about it. There's already reporting that we're going to see a bailout for the farmers, which is widely represented by Republican lawmakers in the United States Senate, including the Majority Leader, John Thune. I think it's fascinating to see tariffs go on our closest trading partners, and Republicans, who just were a couple years ago were the party of free trade and 0% tariffs, now have to get behind the president's justification for fentanyl from Canada being an international economic emergency. So you're going to see some serious backpedaling, which is compounded by the election losses that Republicans are seeing across the country. Obviously with the Elise Stefanik seat in upstate New York, but just this past weekend on 4 amendments in the deep red state of Louisiana, where Democratic voters turned out after being sleepy for 6 years and crushed 4 amendments. We're going to see that in Florida in 2 different districts, the 1st and the 6th, to see what the margins look like. Is it still Trump plus 30, plus 40? Or is it now something that Republicans should be more concerned about going into the midterm? It's a very big vote tomorrow.
How much pressure are Republicans under to make sure they get TCJA extension done sooner rather than later?
Tons of pressure. It has to be done. I think the best triggering mechanism is the X date for Treasury. So we know that we've gotten estimates from outside advisors and CBO that suggest late July to even mid-October is the time horizon. But all the staff on the Hill, which I used to be one, are making sure that we're hearing from Treasury Secretary Bessent. And he's not going to report that date until May. And it really is going to depend on tax receipts. So it's disconcerting when you see DOJ going in and firing IRS employees. It expands the tax gap. And that's really what's going to determine what the X date is. And that's, I think, the linking mechanism for passing this tax bill, which, as you pointed out before, is just an extension of the status quo. There are not and there will not be tax cuts in this bill.
Darrell Cronk of Wells Fargo seeing tariffs having a measured impact, writing tariffs hurt the economy by complicating capex decisions about the future. But today, the issue is mainly price increases, which we foresee as incremental and dilute. Darrell joins us now for more. Darrell, good morning.
Good morning, John.
I have to say, that's a more constructive view from you.
Yes.
Where does that come from? What underpins that view?
Well, I think it's, obviously Wednesday will be big. We're looking at it through kind of 3 lenses. One is, what is the universe, right? So think tariffs on imports themselves. I'm really focused on things like the VAT as item 2, right? Then you've got non-tariff subsidies, things like, where you subsidize an industry, and then you can also have some noise around currency manipulators. Countries are labeled by Treasury as currency manipulator or at least put on watch lists, right? That universe will break down between universal and sectoral. And then I think what we really want to focus on Wednesday is what's known versus unknown, right? So we know the autos, right, at 25%, imported autos and auto parts. We know we're probably going to see the additional tariffs on Venezuelan oil, right? And we know that there's going to be some impact on Mexico and Canada, the USMCA coming back, maybe 25%, maybe less. The key is, do we buy another kind of month of negotiation time, as the Treasury Secretary would say, escalate to de-escalate, right, and some room to negotiate? Or do we just, on April 2nd, let them have it, right, and kind of implement those tariffs?
Do you think that it's going to be reciprocity for each individual country or universal across the board?
I think it's country by country. I mean, I know there was a lot of banter about universal over the weekend.
And the entire campaign trail?
I understand. And I think that's part of that escalate to de-escalate. It's trying to send kind of the worst case message and scenario. But I think what the president and the administration is really interested in doing is negotiating country by country on very specific things. Like, what we still haven't seen is tariffs on pharmaceuticals. We haven't seen tariffs on semiconductors. We haven't seen it on copper, timber, lumber, right? A lot of those sectoral elements that people are talking about are still forthcoming. So whether we get some of that on Wednesday or not, I think is important. But I don't know that I'd look for just broad-based universal tariffs. I think it's a negotiation ploy country by country.
Do you think some countries, say they have a massive export of copper, they will face both?
Yes.
So they will be doubly tariffed, doubly taxed.
Yeah, I think if you break down, so very interested in closing trade deficits, right? If you look at the top three trade deficits, China runs about a $295 billion trade deficit, number one. Mexico, number two, at $175 billion. Vietnam, number three, at $125 billion, right? And then you go down. Actually, Canada is number 8 on the list of actual goods trade deficit. If you close that, and only close that at the same tariff rates as what they charge us, it's about $50 billion worth of tariffs. If I add in the VAT, right, the value-added tax, now we're talking 3x that number. It's about $170 billion by our math. So the VAT matters, I think, in how they're going to play this out in the coming week.
This is a relative game, but who wins, who loses, relatively speaking. I think what's interesting about the call from you and the team at Wells Fargo at the moment is you're sticking with US economic leadership.
Yes.
That's a theme for you guys coming into the year, and you're staying with it as other people change their forecasts. What's interesting about this morning, if you're just tuning into the program, yes, you'll see equity futures down across the board. The S&P down 1%, but check out Japan, down 4%. Check out Germany, down 1.8%. Starting to see, and I know it's very early days and we've seen some massive outperformance in those parts of the world over the year so far, but are things about to change?
Yeah, I think there's a lot of chasing that happened earlier this quarter, particularly. Let's pick on Europe, for example, and the German fiscal spend on defense and everything else. If you go back since 2007, so go back, literally, almost 20 years, 18 years, the time period of sustained European outperformance relative to the U.S., I threw a chart in my notes today, shows that it's on average about 90 to 180 days, and then it fades. Why does it fade? Because you need a sustained lower dollar for that trade to work over any long period of time, and you need earnings to deliver, right? If I went back again to that same time period and said, show me aggregate U.S. S&P earnings, 175%. Show me aggregate Euro earnings, 7. That's the differential over that time, aggregate, right, of earnings growth. So if I don't get earnings growth and I don't get a weaker dollar over any period of time, that trade invariably fades on you. So
far, this trade story has led to a weaker dollar. Do you believe that reverses, and why?
We think it stabilizes here, right? So I would not look for the Dixie to go back to 110 across the broad baskets, but I do think you can have it go back to kind of the 106, 107 kind of range and just stabilize here. I wouldn't look for you just continued weak dollar, right? And if we are, that kind of flies in the face of this growth scare, right? Because obviously, if you're going to get growth scare, what's going to happen? Flight to quality, U.S. Treasuries rally, dollar rallies, right, all that stuff. That just doesn't make a lot of sense to us.
This administration, do you think, wants a weak dollar because they want to see, a rejuvenation of exports?
I think quintessentially the same as a lot of administrations that say they want a strong dollar, but actually want a weak dollar, right? Because the weak dollar favors, economic growth to an extent, as long as it's not a debasement of the currency or something like that. It's just a sustained kind of steady weakness. I think you can live with it. I think what people miss here in the economic story in the near term of U.S. over some of the other parts of the world is you do have rates coming down. You do have the dollar that has come down, right? Labor markets are still okay. We're just about ready to roll into Q2 or Q1 earnings season, excuse me, right? Today's the end of the quarter.
Yep.
So we'll see what people say about earnings.
Do you think we have reset expectations for earnings low enough?
Not yet. I still think that has to come. And I think what happens is whether it's consumer spending, if you look at the drivers of what's been the growth drivers in the U.S. economy, it's AI CapEx, it's the high-end consumer spending broadly, but particularly the high-end consumer, and it's the fiscal impulse, right? So if I lose those engines, right, am I losing AI CapEx? Am I losing the high-end consumer? Am I losing some of the fiscal impulse, right? Something else has to step into that void at this point, right? Which means that growth is going to be anemic here for a while, and it's going to be hard to generate it.
Question marks over all three.
Yes.
Which one of those engines are you most concerned about right now? Because the one that I don't think gets talked enough about is the AI story. We're all obsessing over the trade headlines, but over the past few weeks, we've had some pretty damaging headlines for that part of the market, and it's an important part of the equity market.
Yeah, if you take the top 10 names, obviously in the S&P 500, they still account for 50% of the net income growth in the index. 50%, right? I mean, talk about the skew, right, and lack of breadth that we've talked about many times. So obviously the broadening out of that. What's not discussed, John, is, so we're going to probably put at the end of today one of the weakest quarters as a whole for technology as a sector in probably 30 to 40 years, right? Energy's up 7%, right? Financials and comm services on a relative basis are doing quite well, right, compared to the industry and everything else. It's really centered in tech and consumer discretionary, right? So I agree with you on the AI CapEx. I'll tell you what, though, I watch very, very closely that high-end consumer. Actually, high-end consumer spending and expectations now have dipped below the middle quintile tiers, right? So it's hooking down harder than even the low and middle quintiles. So that's where your discretionary spend comes from. And the question isn't, are they able to spend? They're still able to spend. It's just, are they willing to spend?
That's the big question going into earnings season. I've got some good news. Bonds are working.
Yes.
This has been the allocator's dilemma over the past few weeks. And we've said repeatedly on this program, on down days in the equity market, bonds haven't behaved in predictable ways. Sometimes yields are up, sometimes yields are down. They're down this morning by 6 basis points. Can you depend on that in the year ahead?
I don't think so, because I think what happens is eventually we get a little bit past this growth scare in the near term, and we really, the inflation narrative really starts to come back to the table. So when you look at the long side of the curve, it's really three premiums, right? It's a term premium, it's a growth premium, and it's an inflation premium, right? So if I hold term premium even, I bring growth premium down a little bit, all else equal, that's what's driving the long side of the curve down. But I'm pushing up on inflation expectations and premiums in that long side. The question is, which one wins the day, right? Does the growth scare carry the day? And that's why you see the kind of dilemma that happens. If it's a particular day where a piece of economic data suggests the growth scare is a problem, right? You get a flight to quality, rates down, right? You get a bad inflation reading like we got, although it wasn't bad, but a little higher inflation reading last week, right? 2.8% on inflation. All of a sudden, rates move higher.
Darrell Cronk of Wells Fargo. Of Bank of America writing vehicle prices could increase as much as $10,000 if automakers pass on the tariffs in full. John joins us now for more. John, it's good to see you, sir.
It's good to see you here.
I'm sure you're exhausted, so thanks for being with us.
Yes, I'm very exhausted. There's a lot going on.
And you're going to be exhausted this week too. So let's start with the tariffs. 25%. How much of a pass-through are you and the team expecting?
Well, I mean, it's really unclear. Like you kind of let in there $10,000 on imported autos assembled elsewhere outside of the U.S. would be subject to potentially as much as $10,000 if they decided to pass through the tariffs completely. If they decide to break even in the interim, right? They make a decision. Listen, we're going to keep making vehicles. We're going to try to maintain our market share. They may pass through about $4,500. Or if they do something, even more extreme, they might decide, listen, we're not going to be able to make money on these vehicles. We're not going to import any, and we've got risk of the 7.6 million vehicles that are imported to the United States potentially being at risk. So there's a lot of layers of how this could get passed through and the impact on sales.
The management teams, I imagine, aren't standing still. I'm sure that you've been in touch with many of them over the past week or so. Stellantis, Ford, GM, Tesla. Tesla, limited impact here. Of the other three, how are they preparing for Thursday? What do they do?
Well, I mean, I think we've got the answers for the moment for Thursday. We don't necessarily have the answers for Friday or the following week yet. So the volatility in sort of what's going to happen here, or the uncertainty, is pretty extreme. And I think when you look at this, you're making a product and plant decision about 3 to 4 years out, and then you're going to live with that for about 7 years out from that as the product is launched in the market and produced. So you have a 10-plus year window of committing capital. So it's very difficult on a weekly, monthly, or even annual basis for them to make very significant shifts. So I think at the moment, they're going to look at increasing some employment here in the U.S., trying to ramp up the utilization of their plants here in the U.S. to offset this. But from a large degree, they're not actually doing anything just yet because they don't know the rules of the game, and they're long-term capital allocators.
Who's best positioned going into Wednesday?
So I think if you look at Tesla, Lucid, and Rivian, the startup EV names here in the U.S., they basically are largely unexposed except for some of the electronic components that they would import. Ford is actually in a pretty good position. They're only importing 20% of their volume or vehicle volume here in the U.S., and none of that is really the big ticket items like the Expedition, Navigator, F-150, or even Super Duties. But you go down the list, GM's about 50-50 imports domestic to the U.S. But then you have companies like Nissan, Mazda, Subaru, some of the other names that are reasonably exposed. And I think there's a lot of sort of mid to long-term sort of game theory you have to play here of where the market will go. And I think most of these manufacturers are going to produce higher-end, higher-mix vehicles to try to offset this incremental cost. And I think that's really important to recognize. The low-end consumer is not going to be served, so basic transportation is going to be less available to the American consumer, and if it's available, it's at a higher price. I think the real long-term thing to think here is this is the door opening to the Chinese at the entry level and potentially coming here and building plants, employing Americans, potentially bringing their entire supply chain here and entering at the low end. I think if you sort of run this forward a couple of years, that's the thing we really need to think about.
Are you basically talking about the Chinese companies doing what Japanese companies did 2-3 decades ago?
Correct. We saw the Japanese do it in the 70s and 80s. We saw the Koreans do it 80s and 90s. It takes 10 to 20 years once you're here in the U.S. market to actually really gain a foothold. But I think that's probably what we're staring down the barrel of if this holds.
So the price war already started. It's important to take a big step back here and think about what the last 2 years looked like. We were talking about a real price war in China. We were talking about automakers cutting prices because the demand wasn't there. So when the president comes out and says things like, I don't care if they raise prices, is the consumer price tolerance even there in this economy for them to raise prices?
Well, we're already drifting off of all-time highs in auto pricing over the last couple of years. So I think if we were to look at this and really spread everything that we know right now as best we can, we're talking about a 5 to 15% on average price increase in vehicles. The consumer is not really there for that, so that would have a very significant impact. We kind of roughly were assuming it's a 2.5 to 3 million unit hit to SAAR just based on price pass-throughs, right? So that's a pretty big hit to the market that's about 16 million units right now.
I'd love to go back to more of what the president said over the weekend. To Jonathan's point, he's talking about I couldn't care if these automakers raise prices. He said that then they're going to start buying American cars. The number one car being sold right now in America is a Toyota RAV4, but it's produced in America. So say, would Toyota get an exemption or a carve-out?
Well, I think that RAV4 wouldn't be tariff, save maybe the powertrain and electronic components that are in it that might be imported. We have to kind of dig through that, and everybody's still digging through this. So yes, it might be non-U.S. companies, but it would be U.S. workers that would benefit. And I think that's kind of the ultimate end game. I mean, our rough estimate is you could have 105,000 direct jobs if you brought all that 7.6 million units of production or demand/production back to the U.S., create another sort of almost a million. Another million indirect jobs. So there's a big focus on creating jobs, but there's greater and greater automation at the plant level. So will that actually be sort of a net job gain, or will it just be bringing that manufacturing back here to the U.S.?
You mentioned when it comes to the American producers, Ford's in maybe more decent shape than GM. The issue with GM is their foreign components are Canada and Mexico. Will there be a USMCA carve-out for these autos? Do we know yet?
So right now what we know is on parts that are imported from Canada and Mexico, as long as they're USMCA compliant, basically 75% of their content is North American, that the percentage of the components that are, of the subcomponents that are produced in the US wouldn't be tariffed. Going through that right now is sort of mind-numbing. Nobody actually has the exact answer on that at the at the supplier level, the folks that are actually doing this, and that's why we have a tape delay on the tariffs being put on USMCA compliant components.
This wasn't mind-numbing. This was really thoughtful. John Murphy of Bank of America on what the future of this car industry in this country could look like. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.